Welcome to the deep dive. Our mission, as always, is to cut through all that dense reporting, the jargon, the footnotes, and really pull out the essential nuggets of knowledge for you.
Yeah, we want to help you get truly well-informed without having to wade through hundreds of pages yourself.
Exactly. And today we're diving deep into the Q1 FY26 results for GMR Airports Limited, or GAL. You might remember them as GMR Airports Infrastructure Limited.
That's right.
We've gone through, well, everything. Board meeting outcomes, auditor reports, the investor decks, press releases, all dated July 29, 2025.
A lot of material.
Definitely. And here's a fact to kick us off. GMR Airports. They're the second largest private airport operator in the world based on 2024 passenger numbers, and the biggest in India.
That scale is really something. They're not just a company, they're a major force in global air travel.
For sure. Now, you might be thinking, okay, quarterly results for an airport operator. How does that connect to, the bigger picture? The economy, travel trends, maybe even my next trip.
Well, that's exactly what we're going to explore.
We're about to show you.
And what's really fascinating here, I think, is that these aren't just dry numbers. Not at all. They reflect incredibly complex operations, big strategic decisions.
And how they're handling a pretty dynamic environment, right?
Absolutely. And despite those dynamics, this latest quarter, the one ending June 30th, 2025, it shows some pretty impressive growth, especially in revenue and that key profit measure, EBITDA.
So today we'll look at their overall financial health, how the individual airports are doing both here in India and internationally.
Their big strategic moves like expanding beyond just running the terminals, and of course, their financial resilience. How solid is the foundation?
Right. Let's jump straight into that big picture then.
Yeah.
The overall financial health. Top line numbers look strong.
Yeah, they do.
Total income for Q1 FY26.
Okay.
INR 3,321 crore. That's a pretty significant 32% jump compared to last year.
32% is substantial growth. And their EBITDA, that's earnings before interest, taxes, depreciation, and amortization, basically, their core operating profit.
All right, that came in at INR 12,280 crore. Also strong, up 26% year over year. They called it a record high for the quarter.
And healthy margins, too. 51% EBITDA margin. That shows good operational efficiency.
Okay, but here's where it gets, well, a little more nuanced maybe. Despite those strong operating numbers, they reported a net loss after tax, INR 1.37 billion. Now, that might sound like a red flag, but the report specifically points to a big non-cash foreign exchange loss, about INR 1.4 billion, apparently due to the euro getting stronger.
Okay.
So how should we interpret that? Is a non-cash loss like this a real problem or more just accounting noise?
That's a really important distinction to make. A non-cash foreign exchange loss happens when, say, they hold debt in euros. If the euro strengthens against the rupee value of that debt goes up on paper.
Yeah.
No actual cash has left the building because of that currency move. It's a revaluation. So yeah, it hits the bottom line profit number, but it doesn't really reflect how well the actual airports are running day to day.
So it tells us more about currency fluctuations than operational weakness.
Exactly. The strong EBITDA is a much better indicator of their core operational health and cash generation.
Got it. So connecting that to operations.
Right.
How were passenger numbers?
Right. So across all GA-owned airports, they handled 30.1 million passengers in the quarter.
30.1 million. How does that compare?
It's up 4% compared to the same quarter last year, so year-over-year growth is there. But interestingly, it was down slightly, about 4% compared to the previous quarter, Q4 FY25.
Okay. Any breakdown between domestic and international?
Yep, domestic passenger numbers were up 3% year-over-year. International saw slightly stronger growth, up 5% year-over-year.
And their market share in India is significant, right?
Huge. GAL-operated airports handled 27% more than a quarter of all passenger traffic in India during Q1. Delhi Airport alone was 18.2% of the national total.
Wow.
And international passengers. They made up 23% of the total at GAL's Indian airports. That's important, shows good diversification. They're not solely reliant on domestic travel.
Makes sense.
Yeah.
What about other operational metrics? Things like takeoffs and landings?
Yeah, air traffic movements or ATMs, they had 189,500, which is up 6% year over year. So slightly more flights overall.
And what about how much they make per passenger? I know that's a key metric.
Absolutely. Two key ones here. First, aero yield per pax, or YPP. That's revenue from things like landing fees per passenger. That was INR 399.
Okay.
And that's a massive jump, up 50% year over year and 53% quarter on quarter. We'll get into why shortly, especially for Delhi.
50%.
Okay.
Definitely need to unpack that. And the other metric.
Non-aero income per pax, or IPP. That's revenue from retail, F&B, parking, all that stuff. That was INR 376 per passenger.
And how did that fare?
Also good growth, up 10% year over year and 4% quarter on quarter.
So YPP and IPP really show they're getting more value out of each person walking through the airport, not just relying on more people.
Precisely. It shows efficiency gains and success in diversifying their income streams beyond just flights. Makes them more resilient.
Okay, that paints a pretty healthy overall picture despite that Forex loss noise. Let's go under the hood now. Look at the individual airports, starting with the big one, Delhi.
DI at 8.
Right, the flagship.
Traffic here was actually down slightly, you mentioned. 19.1 million passengers, down 1.2% YoY and 7.5% QoQ.
Yeah, bit of dip.
But the reports give specific reasons, right? Something about geopolitical issues affecting airspace and runway upgrades.
Exactly. They cited temporary disruptions caused by changed airspace conditions amid geopolitical events and runway 1728 upgradation. So likely short-term factors.
Okay, short-term factors impacting traffic, but the financial story for Delhi, completely different.
Oh yeah, polar opposite.
Total income, up a huge 37% year over year, INR 17.7 billion, and EBITDA, just massive, up 61.8% year over year to INR 6.3 billion. They called it the highest in the last 4 years.
Incredible jump.
Even profit after tax turned positive, INR 49 crore versus a loss last year. So what drove this massive financial swing despite slightly lower traffic? You hinted at it with the YPP figure. Bingo. It's almost entirely down to aero revenue. That specific line item surged an unbelievable 127% year over year.
127%.
Yeah. And the reason, as the report states clearly, is the implementation of the Control Period 4, or CP4, revised tariff. That kicked in from mid-April 2025.
Okay, CP4 tariff, break that down for us. What does that actually mean for DIL, and why is it such a big deal?
Think of it like this. The airport regulator, AERA, periodically sets the charges the airport can levy on airlines for using the facilities, landing fees, parking, etc. CP4 is the latest rulebook for Delhi.
And clearly, it's much more favorable for the airport.
Massively more favorable. It allows them to charge significantly higher rates. This isn't just a one-quarter blip. It fundamentally boosts Delhi's baseline earning potential for the entire control period, which usually lasts several years. It provides much higher, more predictable aeronautical revenue.
Wow. So that's a huge regulatory win underpinning these numbers.
Absolutely huge. And it's coupled with other positive regulatory developments, too.
Oh, like what?
Well, this tribunal, the TDSE Telecom Dispute Settlement and Appellate Tribunal, they handle appeals against regulators like AER. They recently quashed and set aside AER's calculation of something called the Hypothetical Regulated Asset Base, or HRAB, for Delhi.
Sounds technical. Why does that matter?
It's super important because the HRAB is basically the value of the assets upon which those regulated charges, like the CP4 tariffs, are calculated. A higher HRAB generally allows for higher charges. TDSA2 told AR to recalculate it within 12 weeks from July 1st.
So potentially even higher revenues possible in the future if the recalculation is favorable.
Potentially, yes. It's another positive indicator on the regulatory front. And then there's the dispute with the Airports Authority of India, AAI, over monthly annual fees, or MAF.
Right, I remember hearing about that.
The Delhi High Court recently upheld the arbitral award, which had excused DIL from paying these fees for a period during the pandemic from March 2020 to February 2022.
There's less money going out.
Exactly. Now, AAI is appealing that decision, so it's not fully final, but it's another favorable ruling for DIL for now.
Okay, so regulatory tailwinds seem strong. What about other activities at Delhi? Those non-aero revenues.
Non-aero also grew, though not as dramatically as aero, up 14% year over year to INR 8.8 billion.
Decent growth. Any specifics?
Yeah, retail was up 5%, with duty-free spend per passenger hitting INR 1,033. Cargo revenue was up 11% as volumes grew 5%, and food and beverage saw a nice 20% jump.
And I saw something about GAL taking over cargo and duty-free operations themselves?
Yes. That's strategically very important. GAL was granted the concession to operate the cargo terminal from mid-May 2025. This followed some issues with the previous operator, Celebi Group, regarding security clearances that matter is still in the courts, mind you.
Right.
But GAL running it directly means they capture more value. And crucially, they also started operating the duty-free business directly from July 28, 2025, after takeover. Again, capturing more of that retail margin themselves.
That fits into that GAL platform idea we'll talk about later.
Yeah.
Expanding into adjacent businesses.
Exactly. And finally, land development around Delhi Airport is significant. They signed a deal with Hilton for 2 new hotels, a Waldorf Astoria, and a Hilton, adding 500 rooms total.
More non-aero income potential.
Precisely. Plus, construction is ongoing for 1 million square feet of commercial office space, a luxury hotel, and various third-party projects covering a massive 12 million square feet. They're building a whole commercial district.
Delhi's clearly a hive of activity, both operationally and strategically. Let's pivot now to Hyderabad GHIL. Sounds like they have a stellar quarter.
Absolutely stellar. Record traffic handled, the report says.
How many passengers?
8.1 million. That's up a very strong 17.1% year over year. And it's the first time they've ever crossed 8 million passengers in a single quarter.
Wow, record traffic. And the financials followed suit.
They did. Total income up 8.5% YoY to INR 6.2 billion. EBITDA up 8% YoY to INR 3.9 billion, also described as highest on record. And look at the EBITDA margin, 65%.
65%. That's incredibly efficient.
Very efficient. And profit after tax was up 24% year over year to INR 63 crore. Solid bottom line growth, too.
Okay, let's look at the revenue mix. Aero versus non-aero.
Aero revenue was up 14.2% YoY. Non-aero revenue grew even faster, up 16.6% YoY to INR 1.7 billion.
What drove the non-aero growth?
Strong performance in retail, up 25%. Duty-free spend per passenger was INR 769. And food and beverage also up 25%. Broad-based growth.
Now, I noticed a little detail. Car park revenue was down 24%. Is that anything to worry about, or is there a story there?
Ah, good catch. No, not a concern at all. That's purely because the car park is now managed directly by the parent company, GAL, not GAL itself.
Ah, okay, so the revenue's still there, just showing up in a different part of the group accounts, part of that platform strategy again.
Exactly right. It's moved up to the GAL level, and Hyderabad's strong performance enabled the board to declare another dividend, INR 2.5 per share for FY25. That brings the total payout for last year to INR 10 per share.
Sending cash back to the parent and shareholders a sign of confidence.
Definitely. And strategically, GHAL made a key move by acquiring the remaining 70% stake in ESR GMR Logistics Park Private Limited, EGLPPL. Made it a wholly owned subsidiary.
So doubling down on logistics and warehousing near the airport?
Precisely. Capitalizing on that whole e-commerce boom and supply chain demand, it strengthens their non-aero portfolio significantly.
Any other notable wins for Hyderabad?
Yes, they secured a big maintenance repair and overhaul MRO contract with Akasa Air for their Boeing 737 MAX fleet. That's a high-skill, high-value service business.
MRO is definitely a growth area.
It is. And they also launched India's first cargo loyalty program called Climb to build relationships with freight customers.
Innovative. What about land development around Hyderabad, similar to Delhi?
Yes, similar strategy. They signed an operator agreement with IHCL, part of the Tata Group, for a 170-room Taj Vivanta hotel. And construction is nearly finished on the GMR interchange that's a 500,000 square foot retail development, and also a large MRO facility for Safran, the French aerospace giant.
So Hyderabad is really leveraging that land bank effectively. Seems like a very well-rounded performance.
Firing on all cylinders, as you said earlier.
Okay, let's quickly touch on the newest domestic airport, Mopa in Goa. GGIL. How did it do?
Mopa handled 1.2 million passengers, which is up 7.3% year over year. Importantly, it captured about 43% of the total passenger traffic for Goa, so it's establishing a strong market position against the older Dapalam airport.
Okay, decent traffic growth and market share. Financials.
Total income was up 8.2% YoY to INR 1.02 billion. So revenue growth is there. However, I saw the EBITDA number down quite sharply, right? 41.6% YoY. Margins fell to 30%. That's right. EBITDA was INR 232 million.
So income's up, but profits down significantly. What explains that?
The report is clear on this one, too. It was impacted by commencement of revenue share.
Ah, okay. So similar to how concessions work, after an initial period, they now have to start sharing a portion of their revenue with the government or authority.
Exactly. For new airports, there's often a grace period before these revenue-sharing payments kick in. Once they start, it directly hits the EBITDA line, even if the top-line revenue is growing. It's a normal part of the project lifecycle.
Got it. So expected, but still impacts the reported profit. Any positives at Mopa?
Non-aero revenue showed healthy growth, up 23.6% YoY to INR 0.2 billion. They've added new outlets like KFC and Domino's kiosks, a United Colors of Benetton store, so they are building out the commercial side.
Okay. And just a quick word on the other big domestic project, Bhogapuram Airport near Visakhapatnam.
Yeah, the Greenfield project there is progressing well. Physical progress was around 80% complete as of June 2025. They're targeting completion by December 2026.
Good to know. Okay, let's pull back a bit and talk about that broader strategy you mentioned, the GAL platform.
Right.
They're expanding into all these airport-adjacent businesses, duty-free, cargo, F&B, car parking, even providing O&M and consulting services.
Yeah.
They say it's less capital-intensive with high revenue growth potential.
Yeah.
What's the real strategic thinking here? Is it just diversification?
It's diversification, yes, but it's more fundamental than that. They're aiming to build, in their words, a perpetual business going beyond the life of existing airport concessions.
Perpetual business, meaning income streams that aren't tied just to specific airport contracts.
Exactly. Think of it this way. An airport concession has a limited lifespan, maybe 30 or 60 years. But if GAL builds strong branded businesses in duty-free, cargo handling, MRO, facilities management, these can operate across multiple airports, win contracts elsewhere, and potentially generate revenue long after a specific airport concession might end.
So it's about leveraging their expertise and scale across the board.
Precisely. It allows for consolidation, achieving economies of scale, buying power for retail, standardized processes for cargo, which leads to better yields and higher margins. And yes, it's generally less capital intensive than building a whole new airport from scratch.
Makes sense. How does this strategy connect to their overall financial picture, especially their debt levels?
Good question. Let's look at the debt. As of Q1 FY26, net debt was INR 329 billion.
Okay, that sounds like a big number. How does it compare?
It's up 17% compared to last year and up 4% just from the previous quarter. Gross debt went up by about INR 10 billion in the quarter and net debt by INR 14 billion.
Why the increase? Where's the new debt coming from?
A few key things mentioned. They raised INR 15 billion through non-convertible bonds, or NCDs, basically corporate bonds. That was mainly used to finance buying out Freightport's stake in Delhi Airport.
Consolidating ownership of their key asset.
Right. Then there's about INR 3.2 billion in new net debt at Vogapuram as construction ramps up there. And remember that logistics park company GAL bought EGLPPL. Its debt of INR 2.6 billion got added to GAL's books when it became a subsidiary.
Okay, so explainable increases tied to investment and acquisitions.
Yeah.
But how is the market viewing this debt level? Are credit ratings okay?
Actually, the market seems quite positive. They highlighted several recent credit rating upgrades. CRISIL gave a new A+ stable rating for a proposed INR 60 billion NCD issue. CARE Ratings upgraded an existing bond to CARE A, stable.
And for Delhi Airport specifically?
DIL's debt instruments also got upgraded to IND-AA by India Ratings and Research. These upgrades are really significant.
Why? What do they signal?
They signal increased confidence from the rating agencies in GAL's future profitability and cash flows. It means they believe the company's ability to service its debt has improved. This generally leads to lower borrowing costs for future debt and better access to capital markets.
So despite the debt increasing, the perceived risk has actually decreased.
That seems to be the view, yes. And they're being proactive about managing it. The board approved a plan to potentially issue up to INR 6,000 crore in new NCDs, specifically to refinance existing, possibly more expensive, debt. That's smart treasury management.
Good to see. What about other parts of the financial strategy? Land monetization.
Yes, that's a big one. They're actively looking to harness potential of prime airport commercial land. They estimate they have over 2,500 acres across their airports with strong real estate development potential.
So building more hotels, offices, retail like we saw at Delhi and Hyderabad?
Exactly. Either developing it themselves or bringing in partners. It's about turning that land bank into long-term, high-margin revenue streams that, again, aren't solely dependent on passenger traffic.
And cost control. Is that a focus?
Definitely. Management mentioned focusing on rationalizing costs, optimizing the cost of debt, and generally improving profitability across the board. Standard good management practice, but important given the scale.
Okay, clear strategy domestically. Let's briefly look overseas. Medan Airport in Indonesia. How's that performing?
Medan handled 1.76 million passengers, up 3.2% year over year. What's interesting there is the split. Domestic traffic was actually down 2.2%.
Oh, why was that?
They attributed it to airlines being slow to reactivate their fleets post-pandemic, which impacted domestic capacity. But international traffic surged 15% year over year.
15%. So international is driving the growth there.
It seems so. Financially, gross income was up 9.1% YoY to INR 1.3 billion, and EBITDA showed strong growth, up 38% YoY to INR 298 million. They still had a small net loss of INR 5 crore, but that's an improvement.
And they're adding new routes.
Yes, Thai Asia started flights to Phuket, and Etihad announced services to Medan, so connectivity is improving.
Good signs. What about the other international projects? Crete.
Crete Airport in Greece is moving along. The key highlight there is that it's a debt-free project.
Debt-free? How?
It's fully funded by a grant from the Greek state and a specific airport modernization and development tax. So GAL isn't putting its own debt capital into the construction.
That's a pretty sweet deal. Less risk for GAL.
Absolutely. Physical progress there is about 54.4% complete.
And Cebu in the Philippines.
GMR continues to operate there, but now as a technical services provider. Their role runs until December 2026. They get fees for their expertise and potentially some extra payments based on how well the airport performs. It fits that capex light service model.
So the international strategy seems focused.
Mhm.
Accelerate the greenfield projects like Crete and Bogapuram, but otherwise look for these lighter touch service opportunities, especially in Asia and the Middle East.
That's exactly how they framed it, judiciously participating, where they can leverage their expertise without necessarily taking on massive capital investment everywhere.
Makes strategic sense?
Mm-hmm.
Okay, shifting gears slightly. Let's talk ESG, environmental, social, and governance. It's increasingly important.
Hugely important.
GMR highlighted significant improvements in their ESG ratings from major agencies like S&P and Sustainalytics. What's driving that?
They attribute it to focused ESG initiatives, enhanced transparency, and public disclosures. Basically, they're doing more on sustainability and being much more open about reporting it.
Any specific examples of initiatives?
Yes, Hyderabad Airports Terminal achieved the top-tier OLI Platinum certification for green building standards. That's a big deal globally.
A light platinum, okay. What about energy?
Both Delhi and Hyderabad airports continue to source 100% clean electricity. That's a major commitment to reducing their carbon footprint.
That is significant.
And another interesting one. They inaugurated India's first integrated electric vehicle, EV charging infrastructure, tailored for airlines and ground handling operations at Hyderabad. So electrifying the support vehicles on the tarmac.
That's quite forward-thinking for airport ground ops.
It really is. It shows they're looking beyond just the terminal building.
And all this effort is getting recognized with awards too, right?
Yes, quite a few. Delhi Airport was named one of the top 10 hub airports in the Asia-Pacific and Middle East region by ACI for connectivity, the only Indian airport on that list. It also got Level 4 customer experience accreditation from ACI World, which is a high level.
Impressive for Delhi.
And Hyderabad. Hyderabad was recognized as the fourth fastest growing airport globally in 2025 by a publication called Aviation A to Z. So both operational excellence and growth are being acknowledged.
Okay, we've covered a lot of ground, from financials to strategy to ESG. Let's try to synthesize this. What are the key takeaways here?
Well, if you connect all these threads, despite some, temporary challenges like that Delhi traffic dip or the Forex impact on the net profit number, the core operational performance, especially that strong group EBITDA, looks very healthy.
Right, the underlying business seems strong.
Absolutely. And the strategic shifts are clearly gaining traction. That CP4 tariff in Delhi is a game changer for revenue there. The expansion into adjacency businesses through the GAL platform is building diverse, potentially perpetual income streams. And the land monetization strategy holds significant future value potential.
So strong core plus smart strategy.
I think so. They have a portfolio of really world-class airport assets, many with very long concession periods left, positioning them perfectly to benefit from the expected long-term growth in air traffic, particularly in India.
And those regulatory wins and credit rating upgrades must help investor confidence.
Immensely. Favorable regulatory outcomes reduce uncertainty, and the rating upgrades make it cheaper and easier for them to fund future growth and manage their existing debt. It creates a positive cycle.
So this deep dive hopefully has given you, our listener, a real shortcut to understanding all the moving parts here. It's not just numbers on a page.
Not at all.
It's a blend of running complex operations efficiently day to day while also making these big, forward-looking strategic bets on things like logistics, retail, MRO, and real estate.
A complex dance.
Definitely. So what does this all mean for you? Well, it's not just about GMR stock price, though that's relevant for investors. It's about the critical infrastructure that makes global travel and trade possible. It's about how these major hubs operate, expand, and innovate.
And the financial and strategic decisions behind it all.
Exactly. So here's a final thought to leave you with. As GMR Airports navigates things like geopolitical shifts affecting airspace, complex regulatory changes like CP4, and strategically pushes into new areas like cargo management and luxury hotels, how might these decisions made in airport boardrooms ultimately shape the future of global connectivity. And maybe, just maybe, impact your own future travel experiences in ways you hadn't considered.
Something to think about next time you're at the airport.
Definitely something to think about. We've tried to give you the context and the insights to see beyond just the terminal gate.